The AI revolution. I mean, it feels like we're on the edge of something massive, right? A whole new era of prosperity. But what if it's all just smoke and mirrors? A recent newsletter from the Macro Butler is asking a pretty gutsy question. Is this really the dawn of a new age, or are we just watching a giant bubble get pumped up by pure greed? Let's dive in.
Get a load of this number, $4 trillion. That is how much value a single company, NVIDIA, has created since ChatGPT hit the scene. I mean, that's one of the most explosive wealth creation events in the history of capitalism. It's insane. But the big question this source material keeps coming back to is any of it actually real?
And look, we're not just talking about any old bubble here. The claim being made is way, way bigger. The author says this could be the mother of all bubbles. Now, that is a huge statement. So let's unpack exactly how they get to that pretty terrifying conclusion.
So if we are in a bubble, what's blowing it up? Well, the newsletter points a finger at one very clear culprit, that absolute tidal wave of cash that flooded the economy during the pandemic, a bonfire of money, if you will.
And this is where the sheer scale of the argument just slaps you in the face. We're not talking about a little bit of overenthusiasm. The claim is that the amount of money being thrown at the wrong things today is 17 times bigger than the dot-com insanity and 4 times bigger than the 2008 housing crisis. I mean, those are just mind-boggling numbers. So how on earth did this happen? Well, the analysis digs into something called the Wixel spread. Now don't worry, it sounds complicated, but the idea is simple. Think of it as the gap between the interest rates the government sets and the natural rate the economy actually needs. When that gap collapses, which it did, big time, money stops looking for smart, productive things to do and just starts chasing whatever's hot.
And you can see the chain reaction laid out right here. It's like a set of dominoes. First, you get the massive government stimulus. That kills the Wixel spread. That in turn floods the market with cheap excess cash. And where does all that cash go? It piles right into the biggest, most exciting story around, the AI hype, a perfect storm for a speculative frenzy.
You gotta love the analogy the source uses for this. Keeping interest rates at zero while the economy was already running hot was, and I quote, like handing out free champagne at a fireworks factory. I mean, what could possibly go wrong, right? The argument is that in that kind of crazy environment, a massive bubble wasn't just possible, it was pretty much guaranteed.
Okay, so we've got the fuel for the fire, all that cheap money. But what's the actual engine driving this thing? The newsletter describes it as a financial conga line. And guess who's right at the front, leading the dance? NVIDIA.
Now, this is a really important distinction the newsletter makes. See, not all bubbles are created equal. You have productive bubbles, like the railway boom or the dot-com bubble. Yeah, they crashed, but they left behind incredibly useful stuff. Train tracks, fiber optic cables. Then you have unproductive bubbles, like the housing crisis or meme coins, that just leave behind a giant mountain of debt and regret.
So the billion-dollar or maybe trillion-dollar question is, which one is the AI craze? Well, the argument here is that because AI hardware gets outdated so fast, we're staring down the barrel of a massively unproductive bubble. The nightmare scenario is that in a few years, we're just left with a bunch of very expensive, very useless data centers.
So what is the weird mechanism behind all this? The author has this brilliant phrase for it: a self-licking ice cream cone. Just picture that. It's this idea of a totally circular system where money just moves around and around to create the illusion of real demand. It's a pretty powerful image, isn't it?
And here's where the newsletter brings out the receipts, literally. Take a look at NVIDIA's accounts receivable. That's basically money they're owed for chips they've already shipped. It has skyrocketed from 56% of revenue to 85%. The interpretation here is pretty brutal. It suggests NVIDIA is basically loaning its own customers the money to buy its products. It's a way to keep the party going, at least for a little while longer.
And if that wasn't enough to make you nervous, another huge red flag is raised. NVIDIA insiders are apparently selling off their stock like there's no tomorrow. And you have to ask, if the people who know the company best are quietly heading for the exits, what do they know that the rest of us don't?
Okay, so we've talked about the money. We've talked about the weird financial mechanics. But what about the actual product? I mean, AI is changing the world, right? Is it actually useful? Well, according to this source, the answer is a surprisingly hard no.
Check out this stat. The newsletter reports that ChatGPT usage drops by 85% when schools are out for the summer. The cynical conclusion it draws from this, that the #1 use case for the world's most famous AI is kids cheating on their homework. Ouch.
And this really gets to the core of the whole argument, this massive gap between the promise and the reality. On the one hand, we're sold this incredible vision of world-changing intelligence, but the view here is that what we actually have are glorified regurgitation machines for homework cheats and toys. It's a pretty brutal takedown. But you're probably sitting there thinking, okay, I get it, but someone must be making money from all this, right? I mean, surely the economics have to work out somewhere. Well, let's see what the newsletter has to say about that.
And this, according to the piece, is the fatal flaw. With normal software, the more you sell, the cheaper each copy gets, and your profits explode. But with AI, it's the complete opposite. Every new user costs you more in computing power. You sell more, you lose more. It's a business model that's totally upside down, and the argument is that it is fundamentally, completely broken.
So after all that doom and gloom, you're probably wondering, what's an investor supposed to do? Well, if you believe the bust is coming, the newsletter offers a pretty clear playbook for how to trade it. First up, what to run away from. The thinking is to avoid anything that's fragile. That means long-term government bonds, which get destroyed by inflation, speculative tech stocks for obvious reasons, and what the author calls digital fantasies. Things with a great story but no actual profits or substance. So where do you put your money instead? The advice is simple. Focus on real, tangible assets, stuff you can actually touch. Gold, silver, energy, commodities. And if you are going to be in stocks, the recommendation is to stick with boring, stable companies that actually make money and don't have a ton of debt. And this all comes down to a really fundamental shift in your mindset as an investor. See, in a normal market, you're looking for a return on your capital. You want to make a profit. But in the kind of inflationary bust this piece is predicting, the goal becomes the return of your capital. It's not about getting rich anymore. It's about not getting wiped out.
And the newsletter leaves us with this, well, let's just call it a very memorable quote it attributes to Confucius. The message couldn't be clearer. This whole thing is incredibly fragile. One little prick and it could all be gone. A pretty sobering thought to end on as we all try to navigate the AI boom, or maybe the AI bust.